Hi everyone, welcome back to the channel. Now, it's of course been a wild few weeks on Wall Street. The market continues to resolve to the upside. The big question is, how long can big tech keep dragging the market higher? Is there going to be a massive correction, or are we going to get a textbook rotation back into a lot of the beaten up names? Now, we all know that there is no shortage of adverse news events. We've got economic turmoil. Everyone thinks the market is hanging on to dear life, but what are the charts actually saying? In this week's video, I'll walk through a high-level broader market analysis with a lot of the key stocks and ETFs that I've shared with our clients over the last week or so, and you can add to your watch lists for the next couple of weeks. Now, I'm told my work is really easy to understand, so hopefully it all makes sense. On one hand, you've got a lot of the perma bears screaming that it's just a matter of time, yet on the other hand, we've got a lot of bulls screaming that the market bottomed in October. Now, just to be crystal clear on things, I'm neither a perma bull or a perma bear. I'm very much open to all outcomes. I assess the data as it comes in. In the current environment, there's literally something for everyone. So my philosophy is what's not to love. If you're bullish, you can buy stocks. If you're bearish, you can short them. But managing risk is always priority number one around here. Now, for disclosure, myself or my clients may already hold some positions in some of the names mentioned, but I have highlighted those disclosures on the charts. If you're new to the channel, I like to use a combination of technicals and fundamentals, and I'm told that I'm very good at removing a lot of confirmation bias from my charts, and I do not use the magical hindsight indicator. I'm also not one of those analysts who makes broad market calls before they eventually play out 6, 12, or even 24 months later. I call my work in real time, and it's for everyday investors, traders, financial advisors, and money managers. And hopefully you understand the Scottish accent. If you find value from my work, please do like, share and subscribe on YouTube, and feel free to follow me on Twitter as well. Very important disclaimer before I get into these charts. Please pause the video, make sure you are comfortable with that. And if you are somebody that requires technical analysis software, we have recently partnered with TradingView. They're absolutely perfect, very cost effective, and there is a link in the description for a free 30-day trial. Now, let's start off with Captain Obvious. Let's get into the charts for the S&P 500 for tech. But we can see that the S&P 500, and I'm using the SPY ETF here, that this level around 420 is a big level. The market is telling us that price has been rejected at these levels multiple times over the course of the last 12 months. The big question is the breadth declines, which is a percentage of stocks trading above their 200-day simple moving average, is the deterioration of breadth a big deal, or will we get an expansion of market breadth on a breakout in the S&P 500? As I record this video, which is around 2 hours before the market close on Friday, we can see once again that the S&P 500 is testing these important levels. We already know this week that big tech has broken out in a massive way. If you follow my work closely on Twitter, or if you follow my YouTube channel, you'll know that I've been covering this chart for quite a while, and we are continuing to make new highs. We've just recently about to close at 13-month closing highs. That is not a bearish characteristic of the market. I understand the other side of things where you can absolutely find stocks to short. So what we're seeing at the moment is we are seeing the leaders lead the market. The best players are winning all the points is a really good analogy that I've heard this week. We've got The S&P 500 continuing to hold above its 10-month moving average, which is a really good risk on, risk off indicator. It's been avoided most of the damage on the dot-com bubble. You would have avoided the damage of the financial crisis, the 2018 correction, the COVID crash, and of course the most recent crash, which I'm probably labelling the economic crash of 21. But the small caps are, of course, I think where a lot of the bearish thesis centres around the deterioration under the surface and what we've seen with small caps. Now, what we've seen last week or during the week on Monday was we had a potential catalyst. The market here tried to break out. It put in an intraday fake out. Now, what you'll find with a lot of professionals is we advocate closing prices matter. Intraday breakouts oftentimes are meaningless to us. We always look for confirmed closes above these resistance levels. Now, as it transpired, we put in an intraday breakout and ultimately it failed, as it often does. And over the course of the last few days, the bears have come out again and they're screaming that the market's about to collapse because of the small caps. I'm not in that camp yet. I think the small caps ultimately test this neckline again and ultimately resolves higher. I think the market and price is currently telling us that we're in a bullish environment, but we have lots of headlines to navigate. We already know that we have debt ceiling news, which is on the horizon. That is a potential catalyst that could tank the market, absolutely. So I am open to all outcomes, but the one chart snapshot of the market, I think probably tells the story better. We've got the Qs breaking out to new 13-month highs. We've got the S&P 500 trying to break out. And I think we've just got the small caps, which are lagging. But ultimately, if the market is going to break out, you would expect the small caps to go with it. And I think if the market does get favourable debt ceiling news, then again, I think there's a breakout here above 420. This would be an environment where you're probably going to see a lot of the big tech names, which I will be covering in just a few minutes. You'll find that there's a lot of big tech names that have already ripped 20-30%. I would probably expect many of those to take a back seat, and you'll find there'll be a potential rotation. It's not just with the US markets. We're seeing the same things around the world. The All Country World Index is again continuing to test these levels at 94. Given the correlation with the S&P 500, if the All Country World Index breaks out, again, that's an environment where you would expect the S&P 500 to go as well. Now, I had many messages over the last few weeks because I've been covering this chart on both Twitter and the YouTube channel, and the tech sector has broken out to new 9-month highs on both an absolute and a relative basis. Again, that's not a bearish characteristic of the market. We're seeing the same thing with the communications sector, which again, it looks like it's going out at new 11-month highs. We're looking at the US dollar index. Now, the US dollar index has been incredibly important for my work over the last few years. We are currently range bound. What happens with range bound charts as they move from the bottom to the top, and of course the top back to the bottom, unless of course it's a double bottom and it breaks out. But the US dollar is really important for me because of the strong correlation that it has with the S&P 500. When the dollar index is rising, that's typically an environment where stocks are going down, and of course if the dollar is going down, then stocks are going up. The big question I have at the moment is, are we now starting to see a decoupling of this relationship? We can see that over the last few weeks, the US dollar index has been going higher, and so has the S&P 500. But it's not just the S&P 500, we can see that, of course, the US dollar index has gone up since the 14th of April, which is when it hit its year-to-date lows. We can see that since the dollar has been going up, this has been bullish for tech. It's been mildly bullish for the S&P 500, but it has continued to hit other areas of the market, as it always has. The small caps, the riskier areas of the market have been hit. As you would expect, gold is taking a hit with a rising dollar. We're seeing the same thing with bonds and commodity space as well. And of course, we've got the financials continuing to hold on despite all the negativity with all the small banks, and of course the regional banks. I think they put in a capitulation a few weeks ago. For disclosure, we made a bottom call on this on the 5th of May, and it is testing its 50-day simple moving average at the moment, but ultimately we hope to see this continue to resolve higher, which again would be another bullish catalyst in my opinion for stocks. But we do have the micro caps holding on, and of course we've got technology. Now, as I said at the start of this, the market is currently running at the moment. I have shared this chart with our members just a couple of hours ago, just highlighting that there is a potential here for a late in the day fade in technology stocks, or some technology stocks I should say. We have met target 2 here in our XLK chart, so it would be very, very normal to see a little bit of a digestion of gains here, and like I said at the start, potentially a rotation into other areas of the market. We've already got the growth versus value chart hitting fresh 9-month highs. So what does this chart tell me? Well, this chart tells me very simply that we need to be looking at growth stocks over value. We've got semiconductors. Now, there's a lot, obviously, with tech at the moment. A lot of folks are wondering when the steam in the engine is going to run out. Now, the semiconductor chart has of course been helped massively by the ridiculous move in Nvidia this week. Now, I will get on to Nvidia in just a couple of moments because I've had a lot of messages, a lot of emails on it because I have been covering it for 6 months. But the semiconductor chart on an absolute basis, we are working with upside targets here around 156. We're obviously at 146 at the moment. This would represent its all-time highs. But what's very, very interesting and more interesting to me at the moment is we're potentially breaking out on a relative basis. Now, semiconductors versus the S&P 500. If you are a professional manager, money manager, and you're looking for outperformance, of course, semiconductors have been the place to be, but they are potentially breaking out above its 2000 highs. This is a base dating back 23 years. The big question is this breakout going to hold? If we are going to break out on a relative basis, you would expect the areas on an absolute basis to move as well. But we all know that there's a big AI craze at the moment, and a lot of folks, and I see it really along financial Twitter, FinTwit, whatever you want to call it. There's a lot of folks that call themselves professionals that are saying that it's 5 stocks that are holding up the market. And that's just not the case. You can go and have a look at things like home builders, and there's many areas, many stocks that are hitting 6, 12-month highs. It's not, the S&P 500 isn't the be-all and end-all for the market. The top 5 mega cap stocks aren't the be-all and end-all for the market. But if you are, like me, somebody that has been invested in Nvidia, I'm sure there's a lot of smugness out there. I think most of us are really, really happy. But what I want to just highlight here with Nvidia is that the stock has gone parabolic. Okay, now when stocks go parabolic, they can run much further than they ordinarily would. Now, I would normally be saying, get out, take profits, let's just wait for a pullback. But with our clients, obviously with our clients, a lot of them have done ridiculous things this year with NVIDIA. I am very, very mindful that RSI is at an elevated level here. But that doesn't mean to say that it can't just keep going. If we have a scenario where we break out in semiconductors on a relative basis, there is an outside chance here that the chart for NVIDIA could keep going here. So my thesis and what I'm working with here is I'm just remaining bullish above 340. I think if we give up that level, then thanks very much, Mr. NVIDIA. Let's move on. But I am hoping on an outside chance here that this confluence of Fibonacci levels with the $500 round number, which is a big psychological number, I hope to see this target met for NVIDIA. We just need to look to see what happened a couple of years ago with Tesla, what happens when stocks go parabolic. I would love to see that happen with NVIDIA, but we'll see how things develop from here. We've also got Amazon. Again, I have been covering this chart on my YouTube channel for a while. We are still working with upside objectives here around 145. We put it to our clients on a breakout above 100, and we'll see ultimately how far it wants to go. Same with Google. Covered this one a couple of weeks ago. Again, it broke out, met target 1, it has broken out again, and we are working with upside objectives there around 150. To the other side of things, I said a few weeks ago that there's no shortage of stocks out there that you can bet against as well. PayPal continues to be a graveyard for investors. Again, it's if it's below these levels here around $66, that's a problem for me. AMD, again, very, very similar to NVIDIA. This has, of course, made a massive move over the last few weeks. This is one of our premium charts from last weekend, but I think it is now reasonable to expect some kind of pullback in AMD. I think given the RSI levels are up at around 82, 83, it would be reasonable to expect a pullback, potentially a retest of the 105 level. That's how price moves. It breaks out, it consolidates, it pulls back, but you would want to see this level hold as support if it does put in some kind of pullback. Now, multiple disclosures here for Micron Technology. We put options contracts out. This is how they've done. Again, chart last week, high conviction idea. But we are approaching target levels in Micron Technology. Around 25 minutes ago, I've posted a chart to our clients and members intraday, just highlighting, thanks very much, Mr. Micron, move on. And ultimately, that's where we are with Micron at the moment. It's been a massive, massive gainer. However, to be interesting, I think we're probably going to get a pullback in some of these high-flying names. And I think a breakout above this level around 76, 77, I think then that brings in logical target number 2. We've got MasterCard continuing to consolidate within its 2-year base. I think if MasterCard is going to get going, I think above $400 we would have an upside objective there around 530. Microsoft, again a chart I've been covering on social media for a while. We've got a 350 target on Microsoft. Tesla, again, just to be very, very clear on this, just around 20 minutes ago I've posted a chart intraday to our members, just highlighting that Tesla is testing its 200-day simple moving average, which we know is a big level for pretty much every stock. It's been a good one. So we'll ultimately see how far Tesla wants to go here. We've got Berkshire Hathaway. I highlighted this one last week on my YouTube channel, just highlighting that we could potentially get a breakout in Berkshire Hathaway. We haven't seen that. It has continued to remain range bound, and it's actually showing a lot of relative weakness at the moment as well. I think if Berkshire breaks down below these levels here, then that might be a problem for that particular stock. Palantir, on the other hand, has been a massive one. Massive 55% move. Now, you cannot, once a stock moves 55% in a few weeks, you simply just, you can't get into it. I think very similar to the likes of AMD, etc. You're probably looking for a pullback on this one. I have been covering this one for the last couple of weeks on the YouTube channel. So again, I'm covering it again, but I think you're probably looking at an environment where we might be looking at a pullback soon on it. Apple continuing to work with upside objectives around 180 to 182. We've got Meta. Again, we're looking at upside objectives there around 271. That's the 61% retracement level of the entire decline. And we've got Spotify continuing to hold its uptrend despite all of the recent chop. Now, a few ETFs that you might want to consider. Again, I have been covering this chart on social media for the last few weeks. We have got the expected breakdown in a lot of the Chinese names. Again, it wouldn't surprise me to see this to test these levels here in EWH and MCHI. What happens at these levels will be key. If it rebounds and breaks back up above these levels, that tends to be a failed breakdown followed by a rip higher. But again, if it rejects these levels when it retests, again, that's confirmation that you're looking at a resumption of the continuing downtrend. Gold remains range bound. And of course, we've got the AI ETF bots. Again, we are still working with our upside objectives around 28.50 there. So I hope you've had some value from that analysis. I would love it if you hit the like button if you're still here. Share my work on social media if you have some followers. But please do check out our website at honeystocks.com. We provide memberships to all of our premium work, which covers our premium weekend analysis. We cover all of our high conviction investment ideas. We provide access to our midweek halftime analysis, access to a wonderful community. You get access to all of our chart books, which covers stocks, ETFs, and commodities. And if you are somebody that's in the process of learning a bit more about technical analysis and process building, etc., we also provide access to our full technical analysis program. So feel free to check that out. But thank you very much for watching, and I hope to welcome you to our platform soon. Thanks.